In the last video, I gave you 5 rules for deferred taxes and how to calculate balances and deferred tax assets and liabilities for multiple choice questions. Today, I'm going to solve a deferred task-based simulation using those same 5 rules. And I've got one loaded up here. So, as usual, look to see what it's asking. Using these exhibits, classify the reconciling items, complete the deferred tax schedule, and record the annual provision. So they give you 4 exhibits here. Let me move my face. You've got book income, net sales, COGS, SG&A, depreciation, etc., all the way down to pre-tax income, book income, $4.2 million. You've got a book to tax reconciliation where it gives you 6 items and it tells you what they are and how much they are. We're probably going to have to determine if those are deferred tax assets, liabilities, or permanent differences. You've got a prior year deferred work paper, excess tax depreciation, 1.8 million, etc. Valuation allowance, and your net deferred tax liability to start this year or to end last year, year 4, of 231,000. And you've got a controller email, probably filled with very useful stuff, little facts that will turn an answer from one thing to another. So you're going to want to read this. The federal statutory rate in effect for tax years beginning January 1, year 6 is 21%. Legislation signed June 12, year 5 increased the federal corporate tax rate to 25%. So we're doing year 5. And this was enacted during year 5. You remember that I think that was rule 3. It depends when it was enacted. So this was enacted during year 5. You use this for your year 5 calculations. Looks like earlier in the year there was a bill for 23%, but that died in the committee. Okay, distractor information, delete it. Doesn't matter. 25% is what you want. Number 2 in the email, no capital asset transactions occurred during year 5, so the capital loss carry forward from prior year is unchanged, $500K. It expires year 7. Our approved 3-year forecast, together with the tax planning study completed in January, projects no capital gains of any kind through the expiration date. The same forecast projects ordinary taxable income of at least $4 million in each of the years 6 through 8, which comfortably exceeds all reversing deductible amounts other than the capital loss item. Our cumulative 3-year book earnings position is positive, and there is no history of expired carryforwards other than as noted. Estimated tax payments for year 5 were made on a separate schedule. Ignore them and record the full current year obligation as payable. Okay, so we've got our question, we've got our exhibits. Now let's figure out what the inputs are. So the task. I'll move my head back out of the way. Oh, right. And if you want this to look like it does in Prometric, you click this little exam day button here in the bottom left, and it switches to a look that you'll be familiar with. When you step foot in Prometric, it's got the same calculation, the spreadsheet, the testlets, 1, 2, 3. It doesn't apply here because we're just doing one sim, but it looks the same. Your exhibits can be popped up and moved around just like at Prometric. But for the video, we're just going to stick to the chat CPA default look. Okay, so part A, here's your inputs. This is what the actual question's calling for. Classification of reconciling items. For each reconciling item, workpaper 12200, I think that was this one, workpaper 12200, yes. Select the classification that applies for the purposes of year 5. All right, so we've got our 6 items here, and we need to determine if they're temporary, deferred tax asset, deferred tax liability, or permanent difference. So environmental fines and penalties, never deductible. That one's permanent. Muni bonds, permanent, always never deductible, permanent difference. Officers' life insurance premiums. So premiums on a key personnel. HMI is the named beneficiary. This is a permanent difference. If the company's a beneficiary, it's never going to be deductible in future years. Those three are the permanent differences. But then the fourth one here, tax depreciation over book depreciation. So you've deducted for tax purposes more than you've deducted for book purposes, meaning you're going to have to you're going to have less of a deduction in future tax years, meaning you're going to owe more tax. That's a deferred tax liability, DTL. Warranty accrual in excess of claims paid. Okay, so that's a future taxable, or you're going to be allowed, the IRS is going to allow you to deduct those when the claims have actually been paid in the future. Thus, you've got a deductible for future years. So the IRS is going to owe you for that. That means it's an asset that you have. Increased deferred subscription revenue. Net increase during the year in customers' cash collected for multi-year caliber of subscription. So for book, you've got a deferred revenue. The IRS does not care about that, doesn't care about you earning revenue in the future. It cares about when the cash was collected. So you've got deferred subscription revenue, $250,000. It's taxed when collected, has not been collected yet. Thus, it hasn't been recognized yet. It's been collected. Thus, the IRS will be taxing you this year for it. However, in future years, you've got a difference that's going to result in less taxes you have to pay. Thus, it is an asset for you. And that's it. That's all 6. So Part B, taxable income and deferred balances. Complete the following amounts for the year ended December 31, year 5. Measure deferred balances using the rate expected to apply when the differences reverse. Yes. So first one, taxable income, year 5. So look for your book income. That's the number you start with. Then you back out or add in the 6 items above. Book income, 420. So let's pop open a calculator. We're going to need to write this down. This was from the video, the multiple choice one. So we start with 420 or 4.2 million. That's your book income. Then look for the 6 items, the 6 reconciling items, and figure out whether you should add them back or take them out of this 4.2 million. So, 120,000 in fines. These are taken on the books, but the IRS will never allow it. So you have to add it back to income because your book income takes those out. So it would have been 4.32 million if you were never allowed to use them in the IRS's point of view. You are not allowed to use them. So add the 120 back. 80,000 of muni bonds. So that's the book income counted it, but the IRS never taxes muni. So you are allowed to take this out. So the 80,000 should be removed from the book income of 4.2. Officers' life insurance premiums. So you've expensed the premiums, but you're the beneficiary, right? So the IRS says that's not deductible. Add it back. 30K. Number 4, excess depreciation, 600,000. Okay, so the tax return is deducting faster than the book, right? That means you've got a bigger deduction now, or smaller taxable income now. So subtract this, minus 600,000. Warranty, 140,000. The books accrued the 350, right? The IRS only honors the 210 that you actually paid. Thus, the unpaid 140 goes back in. Add 140 to book income. And the last one, number 6, subscription deferred revenue. So the cash came in, but on the books, it's deferred. It's not yet booked as revenue. However, the IRS taxes it now. So the books are still waiting to earn it. The books haven't earned it. You need to add it back. 250. And that, sum of everything, should be the answer 4060000. That's your taxable income for year 5. Okay, the second one, total deferred tax liability, December 31, year 5. So we need to figure out from the stuff that happened this year and the prior year work paper what our deferred tax liability is at the end of this year. So what was it? We've got the excess book over the tax depreciation over book depreciation. That's $600,000 for the year. Yes. But what was our cumulative carry forward? It was $1.8 million. Forget this 21%. Remember, it's 25%. So we've got the 1.8 at the start of the year. We got another 600,000 this year. Our answer is 2.4 million times the 24%. There were no other liabilities. The other two are assets. So we've got 2.4 times this year's rate, 25%. It's 600,000. The assets, that's the warranty and the subscription, the deferred subscription revenue. We've got a starting balance of 300 for the warranty, 400 for deferred revenue, and it was 140 and 250. So add that all together. So the 400 plus the 140, that's your warranty. That's 540. No, that's 400. 300 plus the 140 is 440. Times the 25%, we'll have to bring up the calculator for that one. You've got, this is the warranty. 300 to start the year, 140 new in the year. $440 times the 25%, 110 for the warranty. The deferred tax asset, and then the deferred revenue was 400 plus what was this year's 250. Yes. $650 times the 25%, 162, 500. But then you've got this third one, this capital loss carry forward, 500,000. So you're allowed to book that deferred tax asset at the rate, which is 25%. So you've got 500 times 25%, 125. So that's this. The warranty, the deferred, and the carry forward, 397, 500. That's your deferred tax asset at the end of year 5. 397, 500. Okay. And the last one, valuation allowance at December year 5. There was something about that. No capital asset transaction during year 5, so the capital loss carry forward from the prior year is unchanged, 500,000. Our approved 3-year forecast, together with tax planning in January, projects no capital gains of any kind through the expiration date. The same forecast projects ordinary taxable income of at least $4 million in each of years 6, 7, and 8, which comfortably exceeds all reversing deductible amounts other than the capital loss item. So, ordinary income of $4 million projected. That covers the warranty and the subscription, the reversals by far. But the capital loss needs capital gain. And the forecast says that there's none through the year 7 expiration. So the full allowance on that asset, I think it was 125, the 500 times the 25%, the 125, is allowed here. And I think from the prior year, the valuation allowance was 105. Now it's 125. It's only because of the rate change. This is the 21% times the 500 gives you the 105. Now we've got it at 125. That's the only difference. So the answer is the 500 times the 25% or 125,000. And the last item on the sim is Part C, Provision Journal Entry. Record HMI's Year 5 income tax provision in a single entry. Deferred amounts are presented as one net non-current balance for the jurisdiction. Okay, so we need to book the income tax expense, current, and the income tax expense deferred. So income tax expense current, yes, that is go back and find taxable income, which was from the Part B, 4060, times the this year's tax rate. We're not using next year's, so we're not using the 25. Now we're using the 21. So that's 4060 times 0.21, 852,600. And we also want the deferred income tax expense deferred. This one, so take the liability, back out the asset to get the net, add back the valuation, the 125. Actually, probably need the calculator for this one. So you've got the 600 minus the 397,500 asset, and then add back the 125 allowance. You get 327,500, but in the prior year deferred work paper, there was a net deferred tax liability. This is a deferred tax liability as well. There was already a 231. So the change you need is the 231 up to the 327. That's your new balance. So what's the difference? It is 96,500. Oh, and then the credit side of this entry is just the opposite of what you did. This is income tax expense current, but now you need a payable amount. So it's just going to be the exact same, 85,600. Same thing for the deferred. You need to book it, deferred tax liability net, which is the 96,500, just the increase on the account this year. And that's it. Usually I like to give these a once more, but I'm pretty comfortable with all these answers. So let's grade it and see. Lots of green. Green, 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 green. Yes, yes, yes. All green. All of it. All 18 correct. If anything here was marked wrong, we'd go over it and see. But it'll tell you, like when you get stuff wrong, it'll give you like yeah, you might have missed these things, but you actually sort of missed this one topic, and that was all the 4 things you got wrong. The other stuff you figured out and you got right. This will tell you. And then it'll give you like this question was tricking you with this one little tax loophole, or it was baiting you because it planted a 23% when the 25% was the rate you were supposed to use. So yeah, that's it. Same 5 rules applied to the multiple choice questions apply to the Sims, and you can start drilling now. These deferred tax calculations, Sims or multiple choice, whatever. ChatCPA.io. Start drilling today. There's a 20 question free sample for each exam. 20 questions plus 3 Sims on the homepage. No credit card, no login, no sign up. Just enter your email and start drilling.